Hello and welcome to the Paris Fintech Forum Communities Programme. I'm Elliot Gotkin. I'm a journalist and with Laurent Nisri, co-host of this exclusive video interview series, produced with the support of Solaris Bank, Rise and BPI France. Now, the first 3 months of 2021 saw the biggest fundraisings ever for fintechs, with CB Insights reporting almost $23 billion raised in more than 600 deals. At the forefront of this gold rush is fintech-focused investment bank FT Partners. Its founder and CEO is Steve McLaughlin, who joins me now. Steve, great to see you. How are you doing?
Great, Elliot. How are you?
I'm very good, thank you. So look, the first quarter was a record one for fintechs. One imagines that must mean that it's been a pretty good one for FT Partners as well.
Yeah, I think it's a record quarter. We don't really keep track of it like that, but the number of financings, the number of M&A deals we're doing is off the charts right now, quite frankly. And look, it's all driven by all the digital transformation we're seeing through COVID. I think that's accelerating things as we hear in the marketplace every day. I think in the last 6 or 7 weeks, we closed 6 or 7 multi-$100 million financing rounds for companies like Daily Pay, the Zebra, Clearcover. Then we did the largest ever Series B in Brazil with CloudWalk. So just the volume's been crazy, and on the M&A side, the Finicity transaction with the MasterCard last year for $1 billion, the Divvy transaction we just did with Bill.com. I mean, these are multi-billion-dollar deals that are happening very regularly, and I see people joking around on Twitter every now and then that they barely get recognized because there's so much going on. Any one deal is sort of like the news of the moment, but then there's another one the next day. So it's crazy time out there in fintech.
And is this just a continuation of the way things were going perhaps pre-pandemic or, throughout the pandemic? Was there really no pause at all? Because a lot of the fintechs I speak to say they everything stopped momentarily and then kind of dipped right down and then went straight back up. Did you get that as well? Or was it just kind of a straight line for FT Partners?
I mean, there was definitely a panic moment there in the world, I think around, March, April, May, where the world was kind of shut down. And I talked to many VCs. I'd say 90% of the VCs I talked to or growth equity people said, we'll never do a deal without meeting the principals face to face. And that went way out the window. And there was a whole period of time where lots and lots of deals were getting done non-face to face. These days, I think all deals are getting done where there's face to face communication because the vaccine's out and we're on hopefully the back part of COVID, at least in the US and hopefully Europe. And obviously my hearts go out to all the places in the world and people in the world that are having issues with COVID, of course. But no, I think the pattern recognition, Elliot, right now is very high on what works and what doesn't work. Entrepreneurs are figuring it out. Seed and A and B rounds are figuring it out. And by the time these things get to the C or D or E round, they're really figured out. And so it's a bit of a haves and have-nots, because if you have that pattern recognition as a company and what's creating value for customers, what the cross-sell rates are, what the LTV to CACs are, and everything else, investors are finding you and are finding us and then finding the companies. But if you aren't hitting those things and your growth is 10, 15, 20%, it's hard to find capital. So it's not like every boat is rising in the tide. There are some that, the water's going out, and we're seeing a whole bunch of business models that are flattening out. So you're seeing really kind of tale of two cities.
And there was really no impediment to your kind of spotting the next big thing, or people coming to you and you deciding, yes, these are people you want to partner with, or vice versa. Now that you can see people in person again, perhaps will you go back to that full time? Is it going to be a hybrid? How are things from your perspective?
I've been traveling and seeing clients and things like that. It's not impeded me too much, but a lot of it's the clients are themselves not requiring it. At least in this moment, there's still, I think, really just in the last month or so in the US, you're seeing people get their second shots and people are getting a little bit more looser. I've been going to a few dinners here and there and was in New York for 3 days and did a ton of meetings. So, for me, I'm comfortable, but some clients are not. And they just also, I think people are testing out this notion of can we get business done without doing as much travel as we used to? And I think the answer is we can, but it's still going to, in our business, you still need to travel, you need to see people. And so if you can just see more people and get more things done, then that's great. But I think we'll be back to normal within the next 6 months.
And despite your success, you're still comparatively small versus the titans of Wall Street. You've
Yeah.
obviously got a track record now, so I guess that makes it easier for people to know that you're the go-to place for big fintech deals. But when you started FT Partners, presumably it was a slightly harder sell, wasn't it?
Oh yeah, I was just turning 33 years old, and it was only sort of a mid-level VP over at Goldman Sachs. But I gained an immense amount of experience from '95 to '02 at Goldman. It was sort of the gold rush of fintech, pre .com blowing up in the internet days, and our firm helped. Goldman Sachs helped PayPal and raise some of the first rounds of capital that they ever did when they started raising real capital, and many other models. So I learned a lot about it. So I had a lot of credibility, but the firm was only one or two or three people in the early days. So we had to really fight to get great results, and the results have always spoken for themselves. So our mantra is do a great job for clients and business will come. The buyers will see it, the investors will see the great job we're doing, and they'll themselves hire us on other deals down the road. So it's been just one good deal after the other, and as they say, you're only as good as your last deal. Our last deal was Divvy, sold to Bill.com for $2.5 billion. So we're knocking on wood, still cranking them out. But 20 years in, we're about 200 people now, Elliot. San Francisco, New York, London, roughly a third. But I think just in the last few months, we've done multiple deals on 5-6 continents. So we're doing great deals in Asia, Latin America, Africa, as well as Europe and the U.S. So haven't found that big unicorn in Antarctica yet, though.
Maybe there's a penguin there that's got something
Exactly.
Under the surface. But investment bankers moving from one bank to another obviously happens all the time. But it's not so regular for them to leave and then set up their own investment bank. I mean, what prompted you to do that? What gave you the sense that this is something where there was an opportunity, and also an opportunity that you could be the one to grab?
Yeah, I mean, look. Boutique banks weren't so in vogue in 2002 as they are today. There's a lot of business shifting to folks like us and other boutiques around the world. It was a slightly novel thing to do back then, although there were other boutiques, but there was no one doing it in fintech. And today there still isn't anyone doing it at scale in fintech. So there's a couple of 1 or 2 man bands running around, but at the end of the day, we've got 20 years, we've got 500-600 deals under our belts. Like I saw early on, the fintech wave before a lot of people did. I just saw the whole financial services industry moving that way. I mean, I think a lot of the things that I saw during the .com run up that didn't work, it's not that they weren't good ideas. You just didn't have as many people using the internet. People were afraid to put their credit cards in, their social security numbers in. The data and analytics wasn't there. But I was seeing on a daily basis different little pieces of it coming together. And it sort of said, as long as all these pieces start coming together, and it's an inevitability, this space is going to be big. And I can tell you right now, I firmly believe we're still only in the second inning. And I'll just ask anyone in the audience, I mean, is your financial life dramatically better, dramatically more efficient than it was 10 or 15 years ago? No. Little bits and pieces of it here are better. It's maybe better for people to market products to you because they have all the data from Plaid. Maybe it's better for people to lend you money because they have better analytics around doing that. But is your financial life that much better? Is your retirement that much more set? Are you spending and saving the way you should? Are all your stock trades at the most highest level of efficiency? No. None of that stuff is really anywhere near where it could be. So I think the fintech revolution, from the arms dealers to the consumer to the SMB to the government, everything's going to be, much, much different 5, 10, 20 years from now. So we're gearing up for another 20 years ahead. So it's exciting times.
And what's been your biggest challenge, since you set off on your own, as you said, just 2 or 3 people in the beginning, and now, a few hundred people? What was the biggest challenge that you faced? I mean, were there any, near-death experiences or days when you just thought, that's it, we just can't carry on almost?
No, it's funny. I never had the near-death experience type thing. The day I started the business, I went down to Kinko's, got my business cards for $10, incorporated in company corporation.com for $99, and it was really humble beginnings, but I was focused on the client from day one. And I think if you do that and you get great results, then you're never going to have to, think about, folding up the business. So we never had that kind of an issue. We've always been profitable. We've always grown. We publish a chart of our employee growth from, one person up to 200 and something today. So it's always grown every year, even during the financial crisis. I think the key thing has been, how do you scale great execution? It's one thing to have 6 people working 100% of their time on one transaction, and you can do a great job. But how do you get 200 people to work on 50 transactions a year and have all of them be, executed at 10 out of 10 level? And that's something that we've spent a lot of time honing in on, and we've actually tampered down our growth over the course of time. And the mantra has been, we will not grow unless the quality of our execution gets greater, not less. So I think sometimes in investment banking, as these institutions get big, or even as boutiques get bigger, the quality of execution goes down. We've been able to hire better and better and better professionals, train them more and more and more, add more and more support services around the transactions. And now with 500 transactions behind us, we have internal data and analytics that we have a greater level of idea about the valuation of any single private company than anybody else in the world. So the proprietary data and analytics that we have become, quite special. And then the network effect of being at this for 20 years and seeing thousands of transactions go under your eyes, and building up thousands of relationships around the world, the network effect of that is pretty powerful. So I'd say, more broadly, though, building culture, and one of our clients who quotes someone else, Nigel Morris, says, culture eats strategy for breakfast. So I think the thing that we work on to make that company so strong is the culture and the mindset of client service and doing great things for clients. So.
Okay. Well, look, Steve, don't go away, because we're going to take a very quick break, after which we're going to continue our conversation with FT Partners founder and CEO, Steve McLaughlin. Welcome back, and don't forget, if you're not already a full member of our community, everything you need to join can be found at www.parisfintechforum.com. Okay, Steve, got a couple more questions for you before we run out of time. So I want to talk more in general about the kind of fintech space. As we've been discussing, these are boom times for fintech. Are we at the top? Are you seeing valuations of fintech coming down a little, or is it just still going, up to the moon?
Like I said, I think we're in a pretty efficient market. I think that I think some companies, the pricing is very high because the pattern recognition of what it takes to be a great company is known now, right? And I think that you have very serious gradation of investors and valuations, from things growing at 10% to 20% to 100% to 200%. You have different investors at almost every tier in there. You have different valuation ranges in every tier. So you need to know where you are. But no, I think the market's very efficient, very smart. You hear a lot of people saying this investor, that investor is throwing money around and not doing a lot of due diligence. I don't really think that way. I think some of the guys that are throwing money around, that would seem they're throwing money around, are actually doing a lot of work before they throw the money around, and but they're being smart. They're saying, I can do most of my work by interviewing the customers and interviewing the ex-employees and coming up with a thesis prior to contacting the company. And people have flipped from saying, I'm going to diligence you and try to find everything wrong with you, to I'm going to diligence you and tell you how great you are, and I hope you take my money. And this is for the more higher tier companies. And so some of those deals are happening pretty quickly. And I'll just throw names out there like Tiger. Tiger, I think, is one of the smartest firms around. They're seeing these patterns. They have a massive amount of data from all the companies they've looked at, and they can tell very quickly when and how to get into some of the best companies. and what they and others are seeing as well, Code2 and the like, are, when I see that pattern recognition, I don't want to ask too many questions and blow the entire deal. So I think you're seeing that happen. So I think you're seeing some valuations be very high. Like we did a deal with Checkout.com at close to $2 billion on the Series A. A year and a half or 2 years later, it's at $15 billion, right? Everyone thought the Series A was a crazy price, but they've executed. They've done really well. They've blown projections away that we put out in the market. And Guillaume is one of the best entrepreneurs out there. It doesn't take very long to see that. Now there's other companies like Molly right behind it that'll be as big or bigger. So there's that pattern recognition is something that's quite important in this valuation game. But no, I don't think we're at a height. I think we're at a high level, but I don't think that we're overvalued as a sector. And I think just because somebody loses money in a deal, there will be people that lose money. That's fine. That's venture capital. That doesn't mean things are overpriced. That means that one company probably didn't perform, but at the time, I don't think it was overpriced for whatever that company is. So no, we don't see a bunch of companies that we would short. I wouldn't short any of these big unicorns, quite frankly.
Steve, we're almost out of time. So if you can just give me a really, really quick answer. I see that you are reported you are sponsoring a SPAC. Why should fintechs consider going public via a SPAC? And are you worried that the SPAC frenzy might be kind of petering out?
I think SPACs and IPOs and M&A, they're all kind of competing with each other, right? And so as the IPO market gets better, more companies will go IPO. As the SPAC market becomes more attractive, the M&A market. And SPAC is really an acquisition at the end of the day of a private company by a public company. The end result is the private company becomes public. I think there's been a bit of looseness in that market, and I think it's created a little bit of inflation and valuation in that market, and that's given some pushback. I think what's going to happen going forward is there'll be a higher quality company that goes to the SPAC market, and things will ebb and flow. The IPO market's been really, really robust lately, and so people are going that direction. So they'll compete with each other.
Okay, well, I'm sure we could have carried on chatting for another hour or so, but unfortunately we are out of time. So I just want to thank FT Partners founder and CEO Steve McLaughlin for joining me today. Thank you so much.
Thanks, Elliot. Thanks, everybody. Take care.
And I'm going to actually be back next week with another big name from the world of finance and technology. So we hope you'll all join us again then. In the meantime, you can keep up to date with all the exclusive interviews and content from the Paris FinTech Forum Communities Program via www.parisfintechforum.com. See you next time. Bye-bye.